Hi, folks. Welcome back to the pitch stage. Looking forward to this next panel. We're going to talk about legal and regulatory matters. We've got a good spread in terms of different stakeholders who are going to talk about that. We've got some lawyers. We've got people who look at tokens and security in general. We've got Boston Consulting Group for another take on it. And we've also got Sygnum Bank. One of the interesting things that I've seen about Sygnum Bank recently is that a lot of times when you see a traditional bank has stepped into tokenization and crypto, actually it's Sygnum behind them, serving as the back end. So some good and well-qualified speakers to talk on these topics. And looks like we should have invited more lawyers, but it's still going to be an amazing panel, and hopefully people will catch up with it after on the recording. So if our wonderful speakers could come up to the stage, I think this is going to be a good one. I think generally speaking, we're going to have several different takes in the audience on whether regulation is an enabler or a blocker, but I'll be looking forward to hearing how that presentation goes.
All are having the headphones on. Very untraditional for us to wear the headphones on the stage, but okay, I think we can handle it. So our first class, I have no doubts about it, panel is devoted to discussing navigating regulatory shifts topic. So here on the panel, I'm having, with us, we're having Magdalena Bosic, head of regulatory and compliance at the world's first digital asset bank, Sygnum, in Switzerland. We have Asia Gardiner, director and the key consultant for the traditional and DeFi businesses for the Boston Consulting Group in Zurich. We also have Anton Golub, one of the founders and director of the Swiss Asset DAO Association. And last but not least, it's the head of strategy of Token Scope, Sahil Zemini. We would like to start this rather complex conversation by addressing some of the key issues in regulatory developments worldwide. So my first question to the panelists would be to what extent the current trends of the regulations getting more technology specific, getting more oriented at regulating particular points, particular technological advances, such as those seen from the beginning in Gibraltar, when the regulator in Gibraltar informed the participants that if we come to a standpoint that your project is based on blockchain, then its regulation would differ significantly from the traditional finance and legal and regulatory framework. So my first question would be, to what extent that shift is justified? Are we really heading towards technology-specific regulation, devoting from technology-neutral regulation concept? So please, we start with Sahil.
Thank you for that. I think it's a very good question to start off this debate, and I'm very privileged to be joined with you all today. My name is Sahil Zabihi from TokenScope. So when we look at answering this in a two-part way, the first part is, yes, we do need to include technologies to help us assess risks in a better way, specifically in crypto. The second way we can look at this is the adoption of technology, the evolution of technology is happening so rapidly in the blockchain space that every every day we're actually getting new information about what needs to be regulated. So if we turn the attention a little bit to what KYT is, what we're doing at TokenScope is essentially essentially a regulation technology. And what that is it allows a compliance approach, a risk-based compliance approach, for you to identify what your counterparties are doing. and how and what their data is. It's very important to note that we are actually proprietary tech. We run our own nodes, so we don't want to give false alarms on a regular basis to our to the VASPs. And at this point, it's also very important to notice that when you have technology that is giving you these informations, it's something that is very key to what the FATF has identified. So if you look at recommendation 16 from FATF, that is actually the travel route, where they say that just the same way that in money remittance for wires, when funds are transmitted, so too does the personal information of the sender within a specific threshold. So all of these are, systems and technologies that are being used in the blockchain space, which may not be understood by a compliance officer that is coming from the Web 2 or the TradFi space and going into crypto. So
No,
these are important to have.
Thank you.
Understanding.
And Anton, what do you think about the developing a robust compliance system and the role of regulation, and in particular that transformation to technology-specific regulatory model? To what extent is justified? What's your take on that?
So I will start off with a very provocative statement immediately, saying that the lack of regulation for the crypto industry was a key ingredient for the success, actually. Because when you think about it, when you start a new innovative industry, new innovative technology, especially when it wants to compete over the long term with traditional finance, which is highly regulated in our traditional industries, the fact that you don't have strict laws allows you to innovate and try out things. So this is actually a huge, huge benefit. And I remember it in the early days of the Crypto Valley, like together with you, how much we could do actually because we were not highly regulated. We were not a bank, for instance. But then you can argue, and this is what we saw in practice, that lack of regulation doesn't inspire confidence with traditional service providers that you need to actually operate your business. So we remember in the early days of the Crypto Valley, to get your bank account was a heroic success because many times these banks didn't know what to do with you. And in the context of the rollout of the regulation, I'll just kind of give my points there. You can actually take two approaches, which you actually very well mentioned in your question. You can either take a look at this new innovative technology and say, how do we interpret it under the existing regulation? So you don't change the laws, you don't change, which is very difficult, it takes a long time. You don't change the regulation, but you try to look at this new technology and see how do we apply the existing laws, the existing regulation to this new technology, new businesses, such that we give confidence to additional service providers how they deal with you. How does a Swiss bank deal with you? You have the other approach where it says, we create new laws for this industry. We create new regulation for this industry. To be honest, I have had experience more on the Swiss side, which I think Magdalena can say more, is the Swiss regulator was mostly not, or the Swiss government was mostly not changing laws in the early days. They were most looking how do we put you under the existing frameworks. Yeah. And that was highly successful. I mean, Signum, first ever crypto-native bank, regulated bank, was set up and approved by FINMA under that existing banking regulation. So on the other side here in UAE, we have brand new regulation being passed. What is better? To be honest, I think it depends on the use cases. And I'm sure that you will have more thoughts around that. But if I have to choose, or have to give my thoughts around that, I think what UAE is doing is very smart. They're very selective, about creating new laws and new regulations for certain businesses. But for certain lines, which are very, I think, risk-focused, for instance, the central bank is still the ultimate, and the last decision maker in that context. So I think it depends on the use case.
All right. So mostly the regulation of the market should be left for the players themselves. So the Chicago Harvard International, the first adopted doctrine. So the market, the stakeholders, the key market players, they should be able to manage and to regulate it themselves. This is your.
That's the dream, at least.
Okay.
That's the dream. But the reality is everybody else can comment.
Much harder. Okay. Well. Acer, please, what's your professional intake on regulatory developments and technology-specific regulation in particular about that concept? What you have to say? You're very experienced. You are servicing layer 1 protocols at Boston Consulting Group.
Yes.
We have your colleagues been presenting on stage yesterday. We've had fantastic panels. But what's your intake? Maybe some interesting insights that you would be able to share with us.
Yeah, I think coming from this many years of traditional finance and now very deeply entrenched in the digital asset space, the angle that I'm looking at it as the regulator's ultimate goal is to basically reduce the risk associated with innovation. And as that, the regulator, of course, can take the stance of, I really want to fuel innovation, and then I'm going to be relatively lenient, quote unquote, regarding the risk, towards the other side, where no risks for me, containment of the risk is most important, and I am willing to do that even at the cost of innovation. And we see it now all over the world that exactly regulators are taking different positions. But in terms of how they address it, so the whole debate of technology-specific versus technology-agnostic regulation, at the end boils down to how can they address the underlying risks. And in the past, the underlying risks were stemming from, for example, products, derivatives, right? And we had to address that.
Yep.
They were stemming from the banks overloading themselves on credit risk, and that had to be addressed. But now if we look at the underlying risk source, we can say AI. And what did the regulators do? We have EU AI Act. That's great because they are addressing directly what's going on. In the UK, they have this Online Platform Act, which is addressing the online platforms operating model, the risk stemming from that. In the US, we have the cryptocurrency tax, also directed very specifically at blockchain-based assets. So they are realizing that, and they are moving in that direction to address underlying risks linked to technology.
All right, interesting. So, but what's your professional take on particular issues of regulation? Would it be possible, for example, if to ask a more precise question, we all remember the high-frequency trading, and high-frequency trading was a cause of mass malfunctions. So one of the main features, I remember yesterday when I was reading some materials before the panel, preparing for the panel, I remember the high-frequency trading was a big issue to regulate that particular momentum, and it's never been regulated in the real time. In the same way, I think we have the same problem with smart contracts. Magdalena is the head of compliance and RegTech at the world's first digital assets bank. Of course, you are handling these situations on the day-by-day and everyday basis. What would be your intake on technology-specific regulation with regard to the smart contracts not being able, and auditness, of course, it's a huge issue, not being able to be regulated in the process of concluding the transaction. So we have no technical capacities of doing this. I presume, but please.
I mean, you're addressing a very interesting aspect, which is like the decentralized finance regulating DeFi, which is not on the agenda a lot so far. I mean, I've seen it all, I would say, because I've been working in the crypto space since August 2018. I went from experiencing what it is to work under lack of regulation to technology-neutral regulation, which we have in Switzerland because the Swiss regulator, and Switzerland is a very prominent and successful hub for crypto assets. They choose a technology-neutral approach. So they did not introduce a crypto-specific law, but they rather, with the DLT Act, amended 10 existing laws. That was back in 2020. But they started the process, of course, much earlier in 2018. When we look now at the crypto-specific laws, this is a trend that we see. I mean, it's here in the UAE. We have crypto-specific regulation, but also if we look at the European Union with the market in crypto asset regulation, it's also technology-specific. Decentralized finance is out of the scope of these laws and regulations, and I believe. I mean, I'm a lawyer. I love regulation. It gives you legal certainty. I believe that. If it is truly decentralized, a smart contract, self-executing, it's not possible to regulate it. I mean, this is also something that the Swiss regulator states, or that the Swiss lawmakers have as a statement. If it is truly decentralized DeFi, it is not possible to regulate, because you do not have anyone behind who is controlling the smart contract. But if we look a bit deeper, many DeFi projects and setups nowadays, they take DeFi as a statement, but if you look behind, there is a controlling mechanism, either via governance tokens or someone who can change the smart contracts. And then you do not have that element of decentralized finance anymore. It is financial intermediation, and then the existing laws and regulation apply to that. When it comes to what is better, technology neutral or technology specific regulation? I think it depends, as Anton said, on the use case. With technology neutral, you can keep it more general and cover more use cases under it, but sometimes technology neutral regulatory approaches do not account for the specifics of blockchain technology and crypto assets, and I think this is when technology specific regulation can catch that much better. So the favorite reply of a lawyer is it depends, so that would be mine as well.
All right, but who would like to add a number of thoughts on regulation of DeFi?
I just had
on traditional.
Yeah, just something to add. I think it was very well summarized regarding what you said about smart contracts, and I just wish you could tell that to the Department of Justice, because after the past few months of this debacle with Tornado Cash, it seems to be, changing the entirety of what we know as to be under money transmitter for the whole DeFi space. So I think ever since 2013, when FinCEN published their guidance, this has really been a rule book, and it's essentially, if you're accepting funds and transferring them to a second party, you are by technical definition a money transmitter. If you fall out of that scope, which has been the role of DeFi, which has led DeFi to understand that they're not a money transmitter, you don't need to follow the rules such as KYC. But ever since what's happened in this recent Tornado Cash case, which is looking like it will be processed with the courts, is that the Treasury has essentially been stepped aside. The Department of Justice has come in and said that we don't care what FinCEN has said. Even though you don't operate as a money transmitter, we're still going to find you accountable. And that could be a very, very telling tale for the whole DeFi sector.
I would like to add to that, because you're mentioning a very interesting use case, because it was the first time the OFAC sanctions on Tornado Cash was a change of practice of the Office of Foreign Asset Control, because the first time OFAC sanctioned a wallet address and changed its practice was in November 2018 with the Samsung ransomware attack. Yeah. But in August 2022, when they OFAC sanctioned Tornado Cash, it was a smart contract actually. It was a technology being sanctioned, and there is someone who made a joke out of it to show U.S. Treasury and OFAC how ridiculous it is to sanction a technology. They send 0.1 Ether from Tornado Cash wallet addresses to the CEO of Coinbase, to Jimmy Fallon, to the sister of Mark Zuckerberg, changing and exposing these wallet addresses to OFAC sanctioned Tornado Cash in order to show that it is a technology, it is a smart contract that you are sanctioning here, which does not make too much sense. So I like that use case a lot.
Well, it's essentially telling people that it doesn't matter if you've programmed this code, you're going to be held accountable as creating technology, which is not very interesting for technology developers as a whole.
So you so intakes are clear. So you are a proponent of the technology neutral regulation, of application of those the rules developed for the financial market in general, because you are referencing to some examples supporting that standpoint, or you are more towards creating or amending the existing legislation. So should we enact, well, we're not in states, but should we have a particular set of framework of laws governing the wallets, smart contracts, DeFi. As Magdalena noted already, there is a high risk that the weak DeFi might be so-called weak DeFi, not really a full decentralized system, even having in some jurisdictions possibly a website, online website, would be exposing you to some risks to be considered as a not a decentralized system under the MiCA, but as any other, financial company or money transmitter. Again, as far as the so-called big DeFi is very hard to regulate, but absolutely correct. DeFi is out of scope of the regulation. It's hard to touch the issue at all because it's somewhere up in the clouds as far as nobody knows how to regulate what cannot be defined fully. But still, okay. Your take. Do we need a new framework of laws, or what's your opinion?
I think it's just if we're going to have a clear and obvious rule book for, I'm sure a lot of people in this audience are actually from a DeFi space. Maybe they use it for privacy, anonymity. These things should be protected. We're not saying that crypto should be indeed TradFi. We don't want to operate in the same rules as the banks. It needs to be crypto-specific regulations, and anything which can encourage and not hinder the development of new technology is vital.
Okay. Anton, please.
Yeah. So, first, I think you're mentioning great examples when sometimes the regulators have good intentions in mind in sanctioning or sanctioning in the sense of preventing certain things happening, but sometimes where it just doesn't make sense. And from my perspective, I'm always wondering, or this was my experience when I was going through a licensing or a regulatory process. The regulator always asks, but what's the activity that you're doing? Or what's the intended activity that you're doing? And then that's what they want to regulate, right? So you can argue we have technology that preserves privacy. That's amazing. But if you are doing money laundering and you use technology to preserve your privacy, then that's when the regulator wants to react. But I also think many times just the regulation that the regulator wants to put in place, just for me plain doesn't make sense. I'll give you a specific example. Today in Switzerland, there has been clarification of the laws, of the interpretation of the laws and regulation, is what it takes for you to issue a stablecoin. Yeah. And today in Switzerland, if you want to issue a stablecoin, you have to be a bank, or you have to have a bank guarantee for the assets that you hold. Yeah. Now you can say, is this the right approach? And thinking about the activity. My activity, what I want to do is I want to create an instrument that preserves value, that has a stable value, and people use it for transfer of that value. But a bank is supposed to borrow and lend assets. So why are we then forcing a stablecoin issuer to be a bank, but the bank is supposed to borrow and lend? This is the main activity of the bank usually, right? So I think like many times we understand the activity. Do we have the laws and regulations for that activity, right? And I think many times when we don't have it, you make, in my provocative opinion, catastrophic decisions, because I think you should not be a bank if you're issuing a stablecoin. Yeah. As an example.
And following the line of the regulation of stablecoins and developing a robust, effective internal compliance system, what's your intake on central bank digital currencies squeezing out the stablecoin players? So I've heard it numerous times at the conferences worldwide that the central banks worldwide just decided to implement the global project of central bank digital currencies. First of all, aiming at eliminating stablecoins as an institute on the crypto market. So we have tremendous success of the central bank digital currencies in China. Where the risk perceived were absolutely different from the other countries, but violating privacy on numerous occasions, I suppose. But what's your professional intake on that in that realm of CBDC and stable coins, building a robust system?
I think what we're facing across many topics, and this is one of the good examples, is an incredible fragmentation of regulatory thinking, regulatory approaches, and regulatory goals. And in some cases, the regulators are doing CBDC because they want to be proactive, they want to basically be innovative, they want to make sure not left behind. In other cases, they are afraid that they're losing control, potentially over fiscal policy and such matters. So I think it's a bit of a mixed bag in terms of motivation that are behind. I think one very important aspect is that while there are very many pilots going on in this space, and while we can argue that some use cases are more clear than the others, so for example, CBDC in corporate setting is much more already clear versus for retail and so on. But I think that what they're really all trying to achieve at the end, and this is a great hope for the regulator convergence, is that regulatory clarity is gold. And here I would argue, and maybe some of my colleagues will not agree, that sometimes it's even better to just have regulation that is suboptimal, but at least there's clarity, right? I mean, with the US, it's an incredible mess that has put them behind who knows how many years because there is an incredible, outstanding absence of regulatory clarity. And Mika, at the same time, while has a lot of deficiencies, but at least it has put people in this framework that, okay, at least I know what I need to do. I might not agree, it might kill me a little bit, but I know what needs to be done, right? And so the same thing here is that I think whatever the motivation behind is, the faster we go ahead with these pilots, the faster the issues, the kind of hidden or obvious motivations and any kind of feedback arises, the faster we arrive at regulatory clarity, which is the first step to then hopefully regulatory convergence across the jurisdictions.
Thank you very much. And Magdalena, what's your intake? Signum is a Swiss-based, the world's first digital asset bank. What sort of regulatory clarity? To what extent you are happy with the current amendments to Swiss laws and regulations? Anton mentioned the stablecoins, but still, Signum is one of the major players worldwide and one of the major digital asset space players in Switzerland. What's the secret recipe behind your success? Tell us.
There is more than one, I would say. But I mean, I would say the situation in Switzerland is changing because Signum, we have our own stablecoin, actually, the DCHF. We have issued it a long time ago, but we were rather limited because the Swiss regulator considered it necessary that every party holding, if we would transfer it to one party, we would need to identify that party, which makes sense. But even the party passing it on, the stablecoin, to the next party, and then to the next party, to the next party, would have to be identified in KYC. If we look at that and say Switzerland is technology neutral, well, this is not really technology neutral because for fiat assets, if you have cash, if you pass it on to someone, and then to the next person, there is no such requirements. So we're moving away a bit from this technology neutral approach, and it is hindering actually the innovativeness of the technology, because you are facing limitations and requirements that you do not have for fiat assets. So in Switzerland, I think it is what was applicable before now is even stated in some FINMA guidance 06/2024 with the stablecoin guidance. So it's a bit tricky, especially if we look at the European Union and also here in the UAE, where they have the digital dirham that was issued recently. I mean, in the European Union with the market and crypto asset regulation, they have clear guidelines as to how to issue stablecoins. It gives you investor protection, it gives you legal certainty, but it does not limit or unfairly provides a disadvantage to crypto assets compared to the Swiss regulatory approach. So I'm not sure if FINMA will rework that one, but currently it's not very favorable. And of course, I think as a digital asset native bank, you would like to innovate and to go with the technological developments, which is currently rather difficult for Switzerland, I would say.
Rather difficult. All right, so
I think Anton.
yes, just to summarize our thoughts up to this point is that we decided, and it was an interesting discussion, but we came to a common conclusion that some regulatory clarity and particular regulatory framework applied to our activities in the crypto space is much better than not applying any particular rules. But Anton would like to add something. As far as Anton is a proponent of the initial approach of us being able to do much more and to launch much more successful, interesting projects without having even a touch of regulation. Please, Anton.
Maybe also just to add, because I have seen in practice what it means when the end user is offer products within his country or his jurisdiction where you actually don't have adequate regulation, is actually that they end up offshore, which is usually the worst thing that you want to do for the end user, because the regulators, they actually mean well. They want to protect the end user, especially if it's a retail investor, retail client, retail user. But what we have seen in many examples where you don't have adequate regulation locally, these clients end up offshore.
Yep.
And offshore, then you have very little protection, and then very, very bad things can happen. And I'll just throw one word or one company here, FTX.
FTX.
You know?
Everyone
And
knows.
you know, lovely island.
Yes, I think this, but you can mention it for everything, like with them. So, and I think like it's just very important for us to be aware is if you don't have, if we again, the regulators and the countries, governments around the world keep on rolling out suboptimal regulation, or just you can argue plainly bad regulation, it hurts the users in a sense that they go offshore, and when they go offshore, you don't know what's going on, and then not good things happen.
Not
Yeah.
good thing.
So we to summarize
To
to summarize now again, our panel is that we don't see, of course, we don't see technologies as sinister risks, as risks that are evil risks by definitions. But our perception is changing. I would like to add, like Magdalena rightly noted, you know, with the stable coins of Signum stable coins, with the CBDC, as I noted, as Anton said, that you know the for regulator, the project. Leaving the country, going offshore, well, possibly, you know, technology and associations would be a long chain around it. So the technology might be considered as sinister risks under some particular points, and we do not need, in order to allow the innovation to flourish, in order to not to stifle the innovation. We have no rights to complement the development of this concept of the technologies being seen as sinister, evil risks in the society at all. And we are going to start our last session, our last part of the panel discussion of the compliance system. So we start with Magdalena. What are the most interesting and successful examples that you can share of us and our viewers and listeners to adapt to build an effective and robust compliance system? As a head of RegTech at Signum, you know everything about it. I'm absolutely sure about it.
I mean, compliance, I love compliance.
Yes.
Many people might not understand that, but it is the case. And I've been doing it since 2018. So I think when it comes to compliance, crypto compliance, you can use all your existing knowledge and expertise and skill set from traditional compliance and apply it to crypto assets. So it's not such a big difference. I think what I love about crypto compliance is that it is not limited as is traditional compliance. I will give you a concrete example. When I was working in Credit Suisse doing transaction monitoring, if a client sent from, I don't know, some other bank to Credit Suisse, I was able to see that. But I wasn't able to see further behind where did the funds come from, how did they move.
No.
In crypto compliance with blockchain forensic analysis, and this is unique to crypto compliance, you have no such limitations. So now when I conduct compliance checks on the blockchain, looking like, okay, is this plausible wealth assessment, then I can, as every transaction is recorded, I can go back as much as I want. So this is like, I would say you need to add the element of blockchain forensic analysis. You cannot do compliance or crypto compliance without looking like what's happening on the blockchain. Every client type, every wealth generation has a pattern that you can verify there. So I would say it's very important to pay attention to having very good tools when it comes to conducting blockchain forensic analysis, because this is the key differentiator compared to traditional compliance, and this is what is like giving you much more possibilities when you do your compliance checks. Other than that, the same applies that you know from traditional compliance, you can take it over to crypto compliance.
Interesting. And what would be the outcome of a compliance check at Signum Bank if I'm using some alternative blockchains? I'm not speaking about Tron, but something even like much more exotic. How much it would affect the allocated risk to this transaction?
Okay, I mean, nowadays, there was a phase like 2 years ago when there were several blockchains establishing themselves, and the blockchain forensic tools, which are licensed, they were not able to cover it. And you can do cross-chain swaps and all that stuff. But nowadays, I think you can cover like the majority of blockchains. And if then someone is using a very exotic one that is not possible to be covered and checked in blockchain forensic analysis, then I think this would be considered a bit more risk or high risk relationship, where you have to implement additional measures to see and check, like, okay, how can we mitigate that risks?
Successful blockchain forensic element in your compliance system.
But nowadays, I think I would say almost everything is possible to be covered, even privacy tokens, except Monero, because many times the privacy is optional, so you can choose if you want to do it in privacy mode or not, and even that is traceable in blockchain forensics to a certain extent.
Clear. Asya, my next question is to you. As a professional management consultant at the blockchain at the Boston Consulting Group, what would be that key secret element to establish a robust and effective compliance system internally? What would you advise your clients of? What
I will tell you the secret now in 2 minutes. This is what I always preach. Establish fundamentals right. Establish the fundamentals of a risk and compliance framework and operating model right, and then you can have great win in 2 ways. One is you future-proof yourself because regulations will change, one jurisdiction will align, whatever, but if you have the fundamentals right, you're able to adjust much easier. And second is use it to win trust with your customers in the market and broader, which again is a almost necessary element for all of the actors now in the digital asset ecosystem to facilitate the mass adoption, as we just discussed before. What do I mean by have the fundamentals right? At the end, it's very, very simple. If you think of your risk management, you basically first, and no matter who you are, what kind of company, if you're a DApp or layer 1, doesn't matter, you basically map out your risks that are inherent to your business and operating model. It could be that for you, most fundamental is money laundering risk, fraud risk, cyber risk, technology-related risk. You need to map it out. You need to prioritize what is most important. Once you prioritize, you basically build your controls assigned to it, ideally embedded, ideally automatic, and so on, to the key risks. Then you have a process where you check the effectiveness of these controls. When a risk event did occur, did the control work as it was supposed to work, or do I need to adjust it? And then you kind of review it and repeat it. But the second fundamental part of the fundamental is you need to establish governance around it. And I know governance is, again, a big word, traditional word, but in this sense, we're talking about assigning roles and responsibilities and very clear process on what to do when the risk occurs. What should be your escalation path if this is a really huge risk event versus what is a normal operating model if there is, small attempt of cyber attack, nothing happened, you just need to react, right? And why this is important? Because usually when you are talking about responding to risks, so basically bringing them down, mitigating them, doing something, timing is of utmost essence, right? And unless you have these roles assigned, this clear processes assigned based on severity of the event and so on, you're wasting huge time. And then what happens is that there's reputational risks and then comes in, and that's what we see in the media, and we don't want to have that happening, right?
And the role of risk-based compliance system, what are the key elements? Would you recommend a risk-based approach based and calculated out of a risk matrix, or you would use some other metrics in your assessment? What would be that assessment, the initial assessment that you would conduct on the client?
Yes. So you basically can go from very basic maturity level of your framework to very advanced, still following the same goal. You identify the risks, then you prioritize them, which could be literally, in a very simple way, just qualitative discussion among everyone, because of course it's very difficult to compare risks of different nature. Is my cyber risk more than my fraud risk? I mean, in sophisticated way, you have the models where you basically understand what is my potential probability, what is my potential loss, and you calculate that. But even in a simple way, if you're just starting out, then have this as expert judgment and kind of prioritize them based on the expert judgment, which, by the way, is a very dynamic thing. So you need to review it each year because, different things can happen, emerging risks occur, or one risk goes up, another risk goes down, and so on and so forth.
Thank you very much. Very interesting insight from Asya. Anton, as an entrepreneur, here on the panel, what would be the best way to approach the issue of compliance and how to build an efficient compliance system internally?
So,
please.
In my experience, successful compliance very much depends how you build your product. So, for instance, if you build a decentralized finance protocol where things are transparent, where we can look at the code, we can analyze the risks, this can be extremely, extremely successful. On the other side, if you're building a centralized exchange, inside that centralized exchange, it's an informational black hole. Like, we don't know what's happening. We see things coming in and out, but inside, I would argue you have the same risk like in traditional finances, if not even greater. And usually when I used to talk to the regulators and we would tell them about blockchain, about transparency, about smart contracts, and you can read it, they were all very excited. They said, this is amazing. They would love it. But then you would see, you know, in the back of the corner somewhere, usually a person with a lot of gray hair who would not like that. And I would then ask, why? What's the problem here? And they would say, stability. Because in a transparent system, you can watch a protocol collapse in real time. And given the speed of information that we have today, everybody can see it actually, immediately. And I'll give another example again of FTX. When the rumors started that they don't have assets, people were very closely watching their wallets. And then they saw, Alameda Research transferred 500 million from their wallet to FTX. But we had outflows of $500 million.
Yeah.
More rumors are starting. And then you see there's no transfers, outgoing transfers for the last hour. What's happening? And that's the reason why you saw collapse of FTX literally within a couple of hours. Because you had full transparency what was happening, and the people, you know, you can just rationally pick it up and understand it. So I think transparency is great, but the people who have a lot of experience, and I really like that you gave an example of high-frequency trading, when information moves very fast. May 6th, 2010, the flash crash that happened in 15 minutes, biggest collapse in the US stock markets within a couple of minutes. It's speed, technology, and transparency. I think many times when you have outlier events, it leads to extreme instability, and you can watch things collapse in a couple of minutes.
So it's very interesting. Thanks for your very interesting intake. So it's compliance by design and compliance by default. We have to work on developing that product itself. Absolutely. Dahil, please, what would be your recommendations and your intake on building an efficient compliance system, ultimately adherence to the laws? What would be the recipe you can share?
So I'd like to piggyback a little bit on what Magdalena said, and since it was a lot about forensics, and also speaking to what Asi said, first identify the ramifications of what those risks entail. In order to have a good compliance structure, agility is important, right? And if you want to identify those risks, resources need to be allocated, and the right personnel need to be informed, staying up to date. I've met a lot of compliance managers that have a very stringent, very stubborn mentality that leads to not such a good result. I'll name a case and an example. In ADGM, they just issued a big fine to one of the payment processors for not actually implementing a top-down approach to compliance and ML.
All right, so tone from the top is also important.
It is.
Or it's only governance from the top to the bottom. You mean the exact
well,
this
specific case was for not including senior management within discussions repeatedly.
All right.
You know, there's a big difference of having the senior management actually involved and showing face in a board meeting. It's a big difference.
All right, so it's tone from the top and good internal structurings. All right, we have time for one short question from the audience, and it should be a very short one, please. And I'm not sure if we would be able to handle it factually, but you can tell me, and then just a minute, I'll wait for you. Yes.
Hey, thanks for the very good panel. I have a question which relates to ERC 3643 and SSI. So that's
there's too many words, but
okay. ERC.
But we don't know it.
ERC 3643.
All right. Okay. But
which is implemented already on
all right.
RW platforms.
Anybody knows?
SSI
Anybody knows?
That you are referring to now.
Okay. So do we know the answer or not? Because I even don't know these words, so I'm not. Do you know what's the question is about? Because a lot of initials and abbreviations, but.
Yeah, I think it's more to do with Ethereum tech development regarding RWAs. So.
Okay. All right. So you wanna answer this?
I didn't understand the question, actually.
All right.
Based on ISSI.
All right. Yeah. Okay. So yeah, it's built on Ethereum, but it's not in direct correlation to the regulatory shift, I suppose. But if you want, we can yes, if you want, we can continue the discussion and discuss it internally as far as our time is up. I would like to thank you for participating in this panel. I think a lot of interesting intakes, starting from the tone from the top and internal structurings, regulation of high-frequency trading, and whether we need any regulation at all, followed by a precise risk management analysis provided by ASIA, very interesting intakes on stablecoins and regulation of internal compliance practices provided by Magdalena of Signum Bank. I was very impressed by the quality of your answers. I was very impressed by the quality of the discussion. So I would like to thank our dear panelists. On this, we have to conclude. Our time is up. If you have any questions, don't hesitate to reach us. We would be more than pleased to discuss, to continue this discussion on regulation. So thank you very much for your attention. Thank you very much and enjoy your day. Have a good day. Thank you.
Thank you.
Thank you.